Mike, is that the game plan going into the election volatility that you anticipate?
Yeah, nice to be with you, John. I think you just summed it up well with the sort of last segment. I mean, it's becoming very consensus now that this is not going to be a smooth process, and the market's been thinking about that for a while. I don't think that was a new sort of news event last night. I think the market's been thinking about this, and by the way, that's why we have been correcting. One of the reasons we've been correcting over the last 30 days. So some of this is in the price. We think that there's probably going to be more in the price. It needs more gets in the price because volatility is going to remain high. Look at last night's price action as an example. Up 0.7, down 1%. Now we're kind of flat, and that's what we expect for the next 3, 4, 5 weeks. And what that really means from an investment standpoint is you just probably want to dial back your risk overall, and just sort of don't try to be a hero here and make a bet one way or the other. But we do think the overriding message, and we continue to sort of espouse with our clients, is this is a new economic cycle. It's a new bull market. And so ultimately, this will be a dip to buy because we will come through this process into next year, and the recovery will continue. There are risks to that, of course, but we still are very much in that camp, and that would argue that you want to be buying the recovery-oriented stocks into this dip.
Typically, Mike, what we'd say on Wall Street is that we'd like a divided government. Does that hold true going into 21?
That's a great question, John. When you and I have talked about this, probably not, right? I mean, that's probably the one scenario where we could have risk on this fiscal package finally getting through. Our view generally is that if we need more fiscal stimulus, and by the way, it's not clear that we need it, but if we do, we think Congress will come through because the pressure will be too great for them to deny it. Now, if we're kind of in between, right, where the markets aren't really putting a lot of pressure on Congress, and there's not a clear answer that we need it, and we have a divided government, then they will probably drag their feet potentially. So yeah, that definitely plays a role here. But ultimately, John, we think if we need it, we'll get it. If we don't need it, well then great, then the recovery goes on without it.
So, Mike, two ends to this. We've talked about the upside just briefly about where you take exposure. We'll touch on that again in a moment. I just want to talk about the downside. You mentioned in your most recent research the areas of support in the S&P and the NASDAQ 100. Can you just walk it through why and where that is right now, Mike?
Yeah, so, I mean, as everybody knows, we're now in a correction. September, we saw the S&P down about 11% from peak to trough. NASDAQ was the leader on the downside, down about 14%. And look, when you get into one of these periods, all you really can do at that time is go to the technicals. And so very simplistically, look, we're just drawing a line in the sand saying 200-day moving average is a really, really good level of support. That's good news in terms of the S&P 500 because it's only about 6% below current levels. But for the NASDAQ, that's still a pretty formidable drop. And that just speaks to how extended stocks got in this particular recovery. So we think that's something, that's a good way to think about it as an investor. You're trying to put capital to work. You're trying to take advantage of volatility. So as you get closer to those levels, people have different levels of comfort and risk seeking and risk taking. And so we're just saying as you move towards those levels, your risk obviously goes down in taking more exposure closer to those support lines.
So, Mike, let's talk about the fundamentals and the allocation to the upside that you're looking for. And the financials specifically, you guys wrote there's a divergence between the financials market cap, which is talked about a lot on programs like this. What is talked about less is the net income weighting that financials contribute to the overall benchmark. And I just wonder, Mike, do you think that gap can persist, or do you think something needs to change there?
Well, it has persisted. I mean, and by the way, it's not just financials. I mean, this speaks to kind of the recovery stocks. I mean, what's happened, John, is that the market has been willing to pay more for certain types of stocks that have, different growth profiles. And with interest rates as low as they are, there is a willingness to pay a higher multiple for cash flows in the future. It's, it's classic discount rate math. So we do think that the changing agent for this gap to close, meaning the market willing to pay more for stocks that have, upfront earnings as opposed to back-end earnings, is going to be interest rates. And that's probably at the core of our belief, core to all of our calls in the next 6 months, is we really believe interest rates at the back end are going to start to move higher as we get past these near-term risks and it becomes clear that the recovery is continuing. And that will absolutely change, what leads, what does best going forward from a stock market perspective.